Did you think, first and foremost, that the communication side, the messaging, did Jay Powell strike the right balance?
Yes, I think he did. He wanted to make clear that the bar is very high, and it is very unlikely that they're going to be thinking about a rate hike, that the next move is more likely to be a cut. However, he made clear that they're disappointed with the progress that's been made, and they're going to be patient. And I think he did a good job leaving their options open, but reducing the fear that the next move might be a hike. So I thought his communication was right on the money.
The aspect of persuasive evidence that he would want to see before any such move towards tightening is taken, that's interesting, because I do wonder what that sort of evidence would look like given this conflict that you continue to see in this, mixed bag of an economy where you've got historically restrictive rate settings versus relatively still easy fiscal and stimulative effect of other settings. Do you think the Fed can do more to address that dichotomy?
I think they've done what they can, and I think you highlighted the issue, the tension. Monetary policy is historically restrictive. We've had dramatic increases. I think Jay Powell reiterated today he thinks policy is restrictive, but you've got still substantial fiscal policy. We're running over 7% deficit so far this year as a percentage of GDP in the United States. That's historically high for an economy that's in full employment. And that spending is coming from unspent American Rescue Act money, Inflation Reduction Act projects, Infrastructure Act projects, and it's particularly affecting service sector inflation and stickiness of wages in the service sector. And I think that's one of the things that make the United States unique versus the rest of the world. The rest of the world didn't have the level of fiscal stimulus that the United States had and still has. And also the United States is more of a service sector economy versus a goods economy. And I think those are both challenges for the Fed.
And do you see that challenge really persisting or perhaps even worsening, given that we are in an election year?
It might. We really have not seen, we've seen good progress over the last year in inflation, but it's a little bit stalled out on the service sector side. And the reason is the employment market is still still tight. Not as tight as it was a year ago, but it's still tight. And this government spending is fueling infrastructure projects, new manufacturing projects that increase the demand for labor. At the same time, the Fed is trying to cool demand for labor. And so, no, I don't see any prospect this year, at least, that tension is going to abate. And that's why the Fed is going to have to be patient. And what Jay Powell is communicating today rightly is people should expect that it may be several months that they're going to wait before they can take action. And he's not putting any timetable on when they might act. And this tension is why.
We've talked a little bit about the effectiveness of the dot plot, and I know you're generally positive in the way that that's being used to convey expectations. Do you think, though, given we've seen outsized and some would say perhaps incorrect reactions from the markets, that it is still a useful tool?
So the dot plot is useful as far as it goes, but people have to remember it's a snapshot. It's got basically a one-day useful life. The Fed makes pronouncements, say, in March, but a week or two later, they can change their mind based on how the economy develops. I think that probably the issue that the Fed might want to take back is after the December meeting, there was a dot plot that called for 3 rate cuts, was the median, but the rhetoric and the way it was positioned in the press conference was probably a little more encouraging than they might have liked in hindsight. And they gave the market the sense that it would be at least 3 and maybe it could be 5 or 6. and financial conditions eased probably more than they would have liked. So you see now they're going to be very, very careful not to give any false hope to the market and not do anything that unduly eases financial conditions as we go through this inflation battle.